One of the coolest things about my job in real estate investing, getting to coach people and help people buy rental properties, is I talk to people all the time of all different levels of experience. Some are just beginning, some are more experienced. And what's really cool about that is I get to understand and hear what the general common challenges are. What are the common themes people are experiencing? What are the questions people have? What are they not understanding? Or what are they understanding? And in talking to so many people, I feel like I get a really firm grasp on what a lot of people are dealing with. And one of the most common themes is what I want to bring up right here is a lot of people, and rightfully so, when they're going forward on a rental property, they are asking, how do I know if this is going to be a good deal? Is this going to be profitable? Should I go forward on this one? Is it good or bad? Totally justified question. Quite frankly, you should be asking it. But in attempting to get that answer, there is one thing that I am seeing a lot of people do wrong. And I'm going to tell you what that thing is so you can make sure that you're not doing it. The way I'm going to tell you what this number one thing is I'm going to give you two examples. The first one is a very general question that I hear people asking all the time in trying to figure out if a rental property is going to be a good deal or not. The second one is a very specific question that I saw someone put up to a community of investors asking their opinion about whether this property was a good deal or not. I'm going to give you those two examples, and I'm going to give you a second and see if you can come up with a common theme between both of them. And then I'm going to tell you what that theme is, which is also the number one thing that I think you should not be doing in a rental property analysis. If you're stoked for this and you're in total suspense and you're excited about these example little stories, hit the like button. Throw some love. Why not? It's a good time to ask for it. Okay. Here are the two examples. The first one, the general question that I see bukus of people asking. They will ask a community of investors, they'll say, what do you consider to be a good cash-on-cash return? Or in some cases, they may phrase it as, what do you consider to be a good cash flow per month? They want to know how much positive cash flow they should aim for on a rental property. So maybe it's $150 a door per month, or $200 or $50, I don't know, whatever number. They want to know what number is considered a good cash flow, or the percentage equation, the cash-on-cash return. That's the first example. The second example, the specific question I saw on Facebook was, it said, I just bought a rental property for $160,000. The HOA fee is $300 a month. The property rents for $1,600 a month. Is this considered a good ROI? Now, I want you to take a second and see if you can come up with what you think is the common theme between these two questions. And while you're thinking about that, I'll just go a little extra here and point out that the person asking if this was a good ROI based on the HOA and the rent asked it after he purchased the condo. Just a little bonus helpful tip. Please ask that question before you buy the property. Call me crazy. Okay, have you come up with what the theme is between those two questions? Here's what it is. In both scenarios, the person or the people asking the question are only looking at isolated factors and trying to use that as a determination as to whether the rental property is going to be a profitable investment or not. Do you feel that? Do you see that with each example? So let's break down both examples in response to that. The first one, what's a good cash flow or a cash-on-cash return? What do you look for to consider it a good rental property? What that's leaving out is the whole list of factors that also affects your bottom line. For instance, location. Both the bigger market and the neighborhood in which the property is located in. Both of those are going to have a dramatic impact on whether you, first of all, see the numbers that you ran at all, and on long-term growth, and possibly the tenant quality. All of those things play a huge role in the bottom line of a rental property. So just knowing the cash flow and the cash-on-cash return leaves out all those factors. What are some of those factors? I already said location. Rentability. If you're not familiar with that word, I'll link to a video below where it's literally called What is Rentability? It is a word that I'm not hearing enough people say, but ultimately what it means is how rentable is your property? How desirable is it? And that's going to impact long-term growth, vacancy periods, tenant quality, the whole shebang. I think it's the most important factor of any rental property. And then what about upside and growth potential, as I was kind of alluding to? The appreciation front. What if you get such a shackety shack that there's no long-term growth really? Well, what does that do for your bottom line? And then lastly, I did say this, but tenant quality. Who is going to be attracted to that particular property? And if it's a bad quality of tenant, I'm telling you, you may never see one dime that you calculated as to what you're going to get. So on that note, let's say that I have that really risky property. Neighborhood's kind of sketch, property's not that great, upside potential, I don't know. Well, if that cash on cash or cash flow is really high and it well surpasses whatever your limit is, okay, maybe it makes up for all those factors. But if those other factors come into play, like the neighborhood's too rough, the tenants are too bad, no long-term growth, A, are you ever even going to see that cash flow? And B, is it enough to make up for what you could have made had those other profit centers kicked in? So in that case, yeah, you're well past the minimum of what people are like, I want $150 a month per door. Okay, but is that enough to make up for that really risky property? Or if you buy a really nice property in a high growth area, high growth neighborhood, great tenant quality, big upside potential, definitely rentable. In those cases, I'm willing to take a much lower cash flow or cash on cash return because of that upside potential and in exchange for not taking all that risk on. So when people ask this question, what cash flow or cash on cash return do you aim for? My answer is I can't answer that. It's going to be a much higher number on a risky property than it is for a low risk property. So to me, you can't ask, I get where people are going with that question, and it's valid. Like, you want to have some kind of number in mind, but 9 times out of 10, when people are asking that, they're using it as the only factor to determine whether this property is going to be a good rental property or not. You can't do that. I've said it probably 3 times already, because you don't know that those numbers are going to shake out if all those risk factors are involved, and it's negating the other profit centers of a rental property, which I'm going to get to that, so hang on for that one. Now, example number 2, the guy who said, I bought it for $160K, 300 month HOA, rented for $1,600. Is it a good ROI? First of all, again, please ask it before you buy the property next time. And second, what does that tell you? Like, what does the HOA fee against the rental income tell you about anything? It doesn't tell you all the numbers. All of the numbers are what's required to do that part of the analysis. That's not even getting into analyzing the neighborhood, rentability, all those things. Just from the numbers perspective, you cannot determine what the actual numbers are if you only have one expense listed. So you have to include everything, because when I read that question, my first thought was, well, what state is it in? Because if you're in a state with really low property taxes and insurance, you're going to have a lot better chance of that being an okay property. But what if that property that he specifically asked about is in somewhere like Texas? Texas has notoriously high property taxes and insurance. So if you add high property taxes with high insurance with suddenly a $300 HOA fee every month, which is kind of high, I can't imagine that you're going to be in positive cash flow. So you have to include all the numbers. And something related to this that feels very fitting to mention right now is, dun dun dun, the 1% rule. Yes, I know everyone loves to love the 1% rule, but I don't love it. There's absolutely a place for it and there's a use for it, but most of the time I don't see people using it in the correct way. What people are using it for is they'll say, oh, does the property meet the 1% rule? Okay, great, it's a good deal. Or, sorry, it doesn't meet the 1% rule, it's a bad deal. Isolated factors. You're looking at one isolated factor and making a determination about the worth of the deal. In support of the 1% rule, and especially if you have no idea what I'm talking about the 1% rule, I'm going to link to 2 videos below. One that really spells out the 1% rule and why I think it's a scam, maybe not the right word, but it's kind of a scam. And The second one is I actually take two properties in different markets. Property A meets the 1% rule. Property B does not meet the 1% rule. And in the video, all I do is I run the numbers on each property. Spoiler alert, the non-1% rule property in this case had way higher cash flow than the 1% rule property because of things like property taxes, insurance, all that kind of stuff. So make sure to check out those videos because that goes exactly right in line with what I'm saying, is you cannot analyze a rental property based on one factor. You cannot make the determination that a rental property is going to be a good deal based on one thing. Period. Why can you not do that? Well, for starters, if you've watched any of my videos, you've probably heard me talk about the 5 profit centers of a rental property. This is great news. Rental properties make money in 5 different ways. Super exciting. But in those 5 different ways, different factors matter. So if we have cash flow, appreciation, tax benefits, equity build via mortgage paydown, and hedging against inflation, all of those bars have specific factors involved. So if you're asking about cash flow and cash on cash return, that's only specific to the cash flow bar of those profit centers. So you can't look at one item or one isolated factor. You have to look at a whole bunch of them to help you better understand those profit centers, because if you're not familiar with them, they are going to make or break your rental property. That's where all the power is, in those profit centers. So go check out the video below. It's literally called the 5 profit centers of a rental property. And then I'm also attaching a second video where I use those profit centers to explain better how to do a more thorough rental property analysis. Because again, you want to run this rental property and all the factors related to it against the possibility of each of those profit centers. That way we're not just focusing on cash flow. So, what is the moral of this story? Just to recap, the number one thing that I think rental property investors do wrong in their analysis of a property when they're trying to determine if it's a good deal or not is they look at one thing. Maybe they look at 2 factors. I don't know, but it's not usually more than 1, and it's certainly not usually more than 2. You have to look at the big picture of it, not one thing. So just a quick summary, what do I consider to be the big picture? First, numbers. Yes, absolutely. Everyone seems to know that because that's what their questions are about. Yes, you have to run the numbers. If you don't know how to do that, I'll link to another video below that tells you how to do that. So the numbers, then things like, it's all the risk factor related things. Neighborhood, tenant quality, rentability, and upside growth and potential. That's the big picture. It's not as complicated as it sounds. Once you get the hang of what you're looking for, it's not that bad, so don't be intimidated. But you have to understand those things if you want to make an actual determination about whether a property is going to be a good rental property deal or not. So let me know what questions, comments, rebuttals, whatever you have, leave it in the comments because I love open discussions. And maybe you've had an experience where you bought a rental property and you had determined it was going to be a good deal based on one particular factor, and then it didn't turn out quite like you think. I want to hear those stories too. So leave all of that down below. Make sure you've hit that like button. Make sure you're subscribed to my channel because I put new videos out every week. And I want to hear from you. Let me know what you think.